I'm the one that named this the formula. Actually, I named it my TCB formula because it takes care of business. This formula makes money. It was Winston Churchill that said that, "I know that history will be very kind to me as I will be the one writing the history about me." I'm doing this video because I want to make certain that history is going to be kind about me. So, what's the formula promising? First of all, the formula is something that you're in full control of. Nobody's ever going to ask you to give you their money. Secondly, it's a simple, low-risk investment program. And more importantly, thirdly, it's going to promise you a 10 to 40% monthly return month after month after month. Had a lot of people try to tell me what it was because, to be honest with you, even though I was proving it to myself, I still didn't want to tell anybody. It took me a couple of years, and even then they had to dig it out of me what I was doing. A lot of people try to guess what it is. Is it multi-level marketing? No, it's not multi-level marketing. Does it require recruiting? No, but like as not, if you're looking at this video, someone cared enough about you that they wanted you to take a look at it and see if you wanted to build wealth like they are. Is there going to require any education requirements? Well, there's a few things to learn, but no, you're not going to have to go to school for anything. It's going to take a lot of time. You're only going to got to do one or two things every month. So no, it's not going to take much time. What is it then? It's a very low risk investment plan. It's simple and easy to use. Anybody can do it. It gives you complete financial control and allows anyone to do it. Month after month after month, 10 to 40% monthly returns. You ever heard of the rule of 72? It's a little formula designed to show you how long it will take you to double your money if you were promised a certain interest rate. As an example, if you had something that was promising you an 8% annual interest rate, if you would divide that by 72, you would find out that it would take you a little over 9 years to actually double your original money. What I'm about to show you is going to show that you can actually double your money in 4 to 6 months. The rule of 72 does just that. Now you can reverse that. Say you wanted to see what kind of a rate of return you'd have to have in order to double your money in 6 years. You just take 6 years divided by 72. You would then know you need to have an annual rate of 12% if you want to double your money every 6 years. What I'm about to show you, you're going to have a rule of 72 application where you're doubling the money every conservatively 5 to 6 months. It's called compound interest. I think it was Einstein that said the strongest force in the universe is compounded interest. And that's what this is. So what's it require to you to do this? Well, you do need a stock option trading account with a broker, online preferred. It's going to require to buy stock. Don't worry if you've never bought stock before. It's real easy to learn. And when you buy public stock, it's really giving you a shared ownership in a company where you share in the profits or the loss or the dividends or the benefit without you actually having to show up and operate the company. We're going to do 1 or 2 of those transactions a month. It's also going to require getting involved with stock options. Yeah, a lot of people don't know much about options. Quite frankly, those that speculate on options, when they buy them, it really is giving them an option to buy a stock at a certain agreed upon rate, but they have a certain time limit on when they can make the decision to buy the stock at that given rate. It gives them the right but not the obligation, in other words, to buy a stock. Most options that we'll be talking about expire every 3rd Friday of the month. Other than that, you just need some startup money. Doesn't seem to make a lot of difference how much. Most brokers that you set up an online account with is going to have some minimums, of anywhere from $2,500 to $10,000 to open up an account. I would advise at least $5,000 to $10,000 to comfortably get started. There's no limit to how much you can, and it doesn't really change the rate of return that you're going to get. Certainly if you don't have anything out there making you 10% monthly returns or more, you'd want to get that money moved over here because you're in control of it. Is there risk? Well, there's always going to be an element of risk, but the risk in the formula is so minimal, it's almost impossible to call it risky. The stock market itself is risky based on what they have taught people that they need to do in the stock market. Ask anyone, any broker, any analyst, anybody that recommends, every one of them is saying buy stock and hold it. It's the old buy and hold mentality that's been shoved down everybody's throats, to where they've been brainwashed to believe that anything that they invest in needs to be bought and held on to for a period of time. If you used to buy, say, a stock like General Electric, and let's just presume that you could buy this stock at $10 a share, and you bought 1,000 shares of it, the buy and hold says if you hold it a while, it's going to go up in value, and it may. Maybe you hold it for 5 years and it goes up to, say, $13 a share. Well, that would improve your value to where you had about a $3,000 increase in net worth. The thing about it is, no one knows when to sell the stock. You'll get all kinds of different mixed recommendations on how to sell it. Most people won't. After all, if it went up in 5 years to where it was worth $13, why wouldn't it go up in another 5 years to, say, $16? But most stocks move up and then they move down. Sometimes they'll move down less money than what people paid for them. Say this stock that you bought for $10 went down to $9 a share. There's a funny little thing that happens when the price of a stock goes down below what you pay for it. People kind of freak out. They get to thinking about it, having restless nights where they can't sleep as they begin to realize this could go to $8. It could go to $5. Oh my God. It could go to $0 and I'd lose everything. Better just get out of it now while I have a small loss. That's why the majority of the people lose money in the stock market. Happened to me back in October of 1987 on Bloody Monday. Didn't know anything about the stock market, but my money was invested in the stock market through a broker who called me up and said, that the market has lost over 28% and dropping. I'd lost tens of thousands of dollars in just less than a couple hours. He had no idea what to do. He said, you better sell it or you may lose more, and I sold it. About 3 weeks, the stock market was right back up to where it was. Had I just stayed there and kept it, I would have been fine. That's why people lose money in the stock market. When it gets there to where it's gone below what they invested, they freak out and they sell at a loss. Now, people that invest in options, they're not putting as much money on the line, so their risk for the amount of money at risk is low. You know, if $10 would buy a share of stock in a company, why not take that $10 and buy options in 5 different companies at $2? Yeah, the risk is that they have to have action on that stock by the time the options expire on the 3rd Friday. So their risk is based on time and whether or not the stock is going to perform the way that they was hoping it would. Nonetheless, there's on 1,000 shares, the most they could lose is their $2,000, whereas on the stock they could lose the entire $10 if it went really bad. The formula is not going to teach you how to lose money, because it's not about buy and hold. You know, I compare it to the real estate business. I grew up in real estate. Say you had a piece of property down the street that's been on the market for quite a while, say 4 or 5 years, for say $1 million. Don't you think that that seller's getting a little nervous? He hadn't sold the property, he's paying taxes, he's paying insurance. What of you as a speculator? Thought you had someone that might buy that for $1.2 million, you can make a little money. Would the seller be happy if you wrote him a check for $1 million? Of course he would. But now who's going to be the nervous one? You are. You got $1 million laid out and you don't even know if you can sell the property for sure. Options in real estate are a great avenue to take, because if we went to the seller and said, hey, Mr. Seller, I'll write you a check right now for $50,000 if you'll just take that property off the market and give me the right but not the obligation to buy this property if I want it, say within the next 30 days. Would he be happy with that? Of course he'd be happy with it. He's got $50,000. What about you? Well, you're going to be a little happier, because the most you'd ever lose is $50,000. And it gives you time to go see if you can sell that property for $1.2 million. In the first example, if you'd have paid him $1 million and everything went right and you sold for $1.2 million and made a nice $200,000 profit on your money, that would be sweet. But what if it didn't go that way? What if you couldn't get the property sold and it even went down in value and you had to sell it at a loss? That's pretty risky. At least on the options, the most you could ever have lost was the $50,000. And that's all the money you actually ever had to put out of your own money. So you make a nice nifty profit on your $50,000 if you're able to make the deal happen. That's exactly why the stock market works so well for people that they want to get involved with options. You have to understand why options were created. They were created around 60 to 65 years ago by the investment banking industry for a purpose. Speculators have that get rich quick mentality. For a little bit of money, they might hit the right option that will take off, and they get paid in millions of dollars. kind of compare it to going to the casino. Have you ever been to Vegas? You walk in and you watch the people out there gambling, and I'm not a gambler. I like sure things. But they're out there gambling, hoping that they can hit it rich. Get that one hand in poker. Get that one roll on the dice. Get that one crank on the slot machine that's going to make them get rich instantly. I'm certain, absolutely certain, that options were created with the concept of tapping into that mentality where people are drawn into putting a little bit of money down in hopes of striking it rich. You can check with all regulatory organizations, they will tell you the speculators that buy into options, the majority of them lose money. Very few hit it rich on speculating in options. But keep in mind, I'm not going to teach you how to speculate. I'm not going to sit here and kid you. We're not going to speculate one little bit. We want a sure thing. If you go to Vegas, you walk into that casino, you look around, who is it that you see that is making all the money? Is it the gambler or is it the house? Is it the guy in front of the poker table or the blackjack table or the slot machine, or is it the casino? Well, that's what we teach, because it's true about options. Somebody is always making money on those options, and it's not the speculator that's buying them, it's Wall Street that is selling it to the speculator. And they don't want you to know it. They want to keep this secret suppressed. But you can sell options too. You can be like the house. You can be like the casino. We're going to teach you how to tap into that gambling mentality of those speculators that want to buy options by taking a position that the house is doing by selling options. A sure thing. So here's how the formula works. We're going to buy stock and we're going to sell options to the speculators that want to buy our stock. They're gambling that our stock is going to go up. And I can assure you that if we bought this stock here, say for $7 a share, bought 1,000 shares, that would be a $7,000 investment. Well, at the same time, in the options market, they're offering options for those that want to bet on this stock going up. And there'll be a variety of options. It could be $5, $6, $7, $8, $9, $10 strike prices. And each one of them has a price. The ones that the strike price is already below where the stock is accomplished, they're going to be higher priced options. And then there's a multitude of reasons why speculators would buy those options. But for the formula, the only option that we're interested in looking at is the option that the stock is not accomplished yet. In this particular example, the $8 option. And you'll notice that in this example, it could be bought by a speculator for $1.50. That's what the broker is advertising at. That's Wall Street has listed the price at. Here's what we do. We'll buy that 1,000 shares of stock for $7 a share. Milliseconds later, if we choose to do it milliseconds later, we can now sell that $8 strike price option for $1.50. We immediately have $1,500. What's our rate of return? Over 20% return. It's not a buy and hold situation. It's a sell to someone that's buying and holding it till the third Friday. He's got the right, but not the obligation, to buy our stock for $8 a share. And he's under the gun. He's got to get a decision made by the third Friday. We don't have anything that we have to do. We could take our $1,500 and go shopping for it. We have no more obligation. That money is ours right now. So, what if the stock goes above $8 a share? I can assure you that speculator is going to exercise his right. He's going to pay us $8 a share for a stock that we gave $7 a share for. That gives us an additional $1 profit on 1,000 shares. If you combine that 1,000 with our 1,500, we now have a $2,500 profit, or in other words, altogether just a little over a 35% return. What if it doesn't go above $8? That option will expire on the third Friday, absolutely worthless. Come Monday morning, your stock is unpledged. You can now sell options into the next month. Month after month after month. Just like clockwork. Just like a casino. Just like a casino, we're selling that option. Month after month after month. No speculation. I've been doing this for a little bit when I suddenly realized brokers do offer margin accounts to where they'll put up a portion of the money to buy that stock without taking your profits. Yes, they'll charge you a very minimal fee to give you that money. Plus they get commissions, because when I bought that stock, I paid a commission. When I sold that option, I paid them a commission. Well, by freeing up some of my money, they're certain that I'm going to take that freed up money and buy more stock, sell more options. They generate into their pocket more commissions. And as I said, they charge a very minimal fee for the money while you're using it. But let's redo the numbers then. If the broker would offer to pay just half of the amount of money to buy this stock, and I put up the other half, but I get to keep all the profits, now what's my rate of return? On my $3,500, when I sell that option, I have a return of a little over 42%. What if it exercises the stock? Well, now we're looking at over a 70% return. If you understand what I'm showing you, let me refer you back to the rule of 72. Without margin money, we're doubling our money in about 4 months with this example. With margin money, we're doing it in half that time. Now this is just an example. Conservatively, I believe that you can always look that you'll be doubling your money every 5 to 6 months. Here's what's important. Here's what makes this so different than anything that anyone's ever looked at before. It has 5 rules that have to be followed.